Hi, my name is Kris Venezia. I'm an advisor here at Ekman Wealth Management, coming to you on a dreary day in late December in Brooklyn, New York, and doing a video. We don't necessarily love to do like forecast videos, but doing a video looking ahead at 2024 and talking through what are the things that we're really looking at and monitoring and the items and issues we think that will have a meaningful impact on both what happens with the markets and what happens, with global developed economies. And of course, our bias is here in the United States. And the first item, we're still talking about it, been talking about it for quite a while now and feeling it for quite a while now, and that's inflation. Inflation has come down, so prices are still going up, and they're still going up faster than certainly central banks and consumers would like them to. We're just over 3% on the CPI, and there's other, Fed looks at PCE core and all these other things, but roughly, let's say inflation is kind of around or just above 3%, depending on the index you want to look at. And as we look ahead, I think if I was going to say what's the concern, certainly concern as the calendar flips into 2024. Do we see services and other industries raise prices? Do we see a bout of wage hikes? Labor market still certainly strong. Do we see wage hikes as employers try to keep and maintain the workforce that they have and maybe still in some ways compete to keep that talent? But the flip side of that, if you wanted to be positive, and I think this is something the Fed behind the scenes is banking on, is housing inflation should start to come down, more forcefully in these upcoming reports based off of how the housing data is put together. It has long lags, and we know that rents, especially, depending on where you look, flat to down year over year on a lot of the metrics we look at. Whereas if you look at, CPI has, I think, year over year housing at 5.5, maybe close to 6 in the last CPI report. So there's a discrepancy and certainly some hope that housing helps to bring those inflation numbers down. And other people look at lags and things like used car or new car. And if you look at the real time like Cox and kind of drag it out, there's people hoping you see some help there as well. So some push and pull, people being optimistic on inflation largely because of that housing component. But certainly we could see that reacceleration of inflation. And of course, I'll talk about this a little more later in terms of conflict, but you still have, a lot going on in the Middle East, blockages and not blockages, but attacks in the Red Sea. That type of stuff could certainly have an impact on, some of the commodity side of things, especially when it comes to energy. Talking and moving to housing broadly, I think the big thing to watch is rates have come down, and we touched 8% on a 30-year. We're down in the upper sixes as I talk to you right now on a 30-year, with the expectation that it'll fall to around 6.5, based off of the moves of the 10-year. And there's sort of this kind of dueling arguments here of the one side of it, and this is, I think, if I had to pick a camp, this is where I would be. This feeling that as rates come down, you have all these people that are out there that have been kind of golden handcuffed to their homes because they have mortgage rates at sub 4%. If rates come down and maybe they can get a 6 or an upper 5 or even now at a 6.5, does that put them in a position where they say, yeah, I'm going to have to exchange this lower mortgage rate for a slightly higher mortgage rate, but I feel more comfortable with it, and it's time for me to make that life change. I'm tired of living in the city. Maybe I'm getting older and I want to downsize. And, to kind of expand on that, life events, how many life events are happening that are going to force people, job relocations, how much of that is happening going to force more supply on the resale side into the market, because that's an area that's just been such an issue. That supply side on housing, it's kept housing prices high and made things extremely difficult, especially for that first time home buyer. So, curious to see if rates coming down helps with the supply side. Of course, the flip side is, do rates come down, bring a rush of people off the sidelines? I think people in their 30s, that millennial that wants to buy that first time home, maybe they've been sitting there padding the savings, and this is kind of that situation that they're looking at and they're saying, hey, rates have come down a little bit. This feels more affordable. I've been waiting 2, 3, 4 years to buy this home. I'm going to come off the sidelines and do it. And, I think my hope would be that you get a healthier environment where supply increases as demand increases and we can match that up. it's probably being a little too optimistic. And I think the biggest thing, and this is what, when you look into housing, the people who are more focused on that than me, there's just such a discrepancy right now across the country. Whereas like at parts of Texas and Louisiana, if you look at parts of the Northwest, certainly things are much softer, or appear to be from the data much softer there than other parts of the country in the Midwest, or maybe parts of the Northeast, or even Florida is just so hot. Those areas that appear to continue to be hot, where you continue to see home price growth and those home prices staying high. So I think you're going to continue to see that, just different markets performing differently as we get through 2024. Looking at labor, there's been this expectation for so long that the labor market's going to loosen, that the unemployment rate is going to go up. It just feels, right, rates went up so much, it just feels, inflation's come down, it feels natural, that push and pull, that we should see unemployment rise. But man, it's been tough, because we've gone through such a long period of waiting for that to happen, and still seeing payrolls expanding, and still seeing the last JOLTS report showed a larger availability, a decrease in the number of job openings, but it's still high when you compare it to the number of people actively looking for a job. When you look at the data, the unemployment rate is still low, still adding on these payroll reports, but we'll see as we get into next year. I think, to me, do companies look at where they're at and say, hey, I'm in a position where I want to cut costs. Where can I trim some of that fat? I think about Nike and FedEx, who recently did, release earnings that were a little disappointing. A big point of emphasis on their earnings calls: efficiency, streamlining, cost cutting. How much of that is going to come from jobs where they're saying, hey, we can eliminate some of these roles? Does that expand? That's what I'm looking for on the labor market. But it's just, it's hard, because the expectation for so long has been, unemployment's going to go up. It just hasn't happened. Certainly continue to watch the labor market and see how things unfold there. On the rate side, Fed in December, I don't like to say forecasting because they hate that, but on December, they said their expectation, largely, if you looked at most of the Fed participants, that there would be 3 rate cuts in 2024. Market expecting closer to 5 or 6. Yeah, people talk a lot about rate cuts. I understand that it's a big component of trading and all of the forecasting and all of that. To me, it just comes down to the data. If we continue to see inflation progressing the way it has, if we get that help from the housing side that everyone's expecting in future inflation reports, if the labor market stays roughly where it's at now, where it feels like we're kind of coming more in balance on the labor market, more when you read the survey, like the Beige Book, that type of stuff, you're reading more of, in the survey data, employers feeling like they're in a better spot. If that type of stuff continues, you could see more rate cuts. But really, it's hard to say, hey, there's going to be X rate cuts or Y rate cuts. It just depends on the data. It's really just that simple. The inflation data, some of that labor data, and depending on what happens there, that's going to dictate the rate cuts. And I think the bias right now is for more than 3. Certainly, we'll see what happens. Certainly, the market's going to react most likely negative if we get to a position where, instead of 5 or 6, or 3 or 4, if we get to a position where rate cuts are going to happen later in 2024. Right now, market looking at March, a lot of people kind of talking May. If rate cuts start to happen much later in 2024, or if that gets pushed out, certainly you'd expect, the market to take that poorly. Conflicts, I'm not going to talk a lot about this, but, we still have conflict in Ukraine. We have what's happening in the Middle East. Certainly, we continue to hear that rhetoric about China in Asia. So conflicts, I think this is always going to be a theme, unfortunately, but, there's going to be impacts on, a lot of things based off of conflicts. And there's already been impact, based on the conflict. Certainly that war in Ukraine having big impact on the commodity side of things. A lot of elections next year, not just in the United States, but globally. Another one that's going to have impacts, another one that's going to sway the markets. But at this point in time, I don't know if there's predictions or anything there. People are going to make their own predictions. I know politics is part of this, but just a lot of elections to look out for next year. Conflicts, elections. I think the final thing I'll touch on briefly too, that I'm interested in, I don't think I've necessarily heard a lot about is earnings. Markets had this big rally. In order to continue and sustain that rally, earnings have to provide some of that support. And there might be a little bit of a lag of companies if they're able to come out and say, hey, this wasn't great, but we're cutting costs. And later in the year, things are going to get better. Maybe investors can buy some of that with some companies, but at some point, we're going to need to start seeing it from earnings, and we're going to need to see it more broadly from just the big tech who cut costs and has that pricing power. We're going to need to see more power and more growth in earnings from a broader, a group of companies, not just the big tech companies and the Nvidias and Microsoft, all those. We need to see that earnings growth come, from a broader group for me to feel more confident about, okay, we're really entering this cycle where we're accelerating. And FedEx had a disappointing earnings, Nike some disappointing earnings. Maybe that's competition, certainly an aspect of inflation maybe in there as well, and the dollar, Nike pointing that out. But to me, these are the things, the FedEx, the UPS, your industrials, your Honeywells, those are the companies as we get through 2024. I'd certainly like to see them performing better, because it would speak more not just to what's happening in the U.S. and the ability they have to grow and to support their kind of multiples, but also it would support the global side of things. Can we have global growth as inflation comes down globally, as central banks around the world start thinking about rate cuts, as or as China, as China tries to accelerate and come out of their funk. If we can see these global companies doing better, to me that says a lot about, okay, we're in a healthy spot, and the economy globally is in a healthy spot with inflation in a more comfortable position than it's been the last 2 years. So yeah, that's kind of what I'm looking at for 2024. Certainly appreciate you watching, tuning in, subscribe, do all that. If you disagree with me, if there's something you're watching that I didn't point out, put it in the comments. Certainly love to kind of hear other people's inputs and see what other people are watching, and converse and dialogue that way. So thanks.